Hey traders, this is Ron Haydad Financial. Happy Sunday. Happy New Year. Hope your New Year's off to a great start and your holiday season has been amazing. In today's video, we're going to talk about the major indexes, some important stocks. We'll dip into the metals and miners, and we'll also touch on Venezuela as well. But before we go any further, it's important that we show the disclaimer that everything is for educational purposes only. It's not advice to buy or sell. Past performance, no guarantee of future performance. Okay, I have Thinkorswim as my charting software here. This is my real account, and the S&P 500 ETF, the spiders, is on our screen. So this being a one-year daily chart, one candlestick represents one day in the market. And here's where we are today, and this is where we were a year ago. You come down here in the lower right, you can see the timestamp of when I'm doing this video. It's almost 2:30 p.m. Eastern here on the first Sunday in January. The big question that I've been getting asked is, what does the news in Venezuela do? And I don't want to go into the political sides of it. I want to go into it just how it would focus on the markets. And my guess will be as good as yours. I'll tell you what my gut is from what I'm seeing so far. And that is, it's going to be basically a non-event. We just won't know for sure until tomorrow. Tonight at 6 p.m. Eastern, when the markets reopen, we could see some of the indexes start going a little wacky, possibly initial reaction. But that could all be undone or made worse or better by the 9:30 a.m. Eastern open. So usually it takes one day to shake these things out. So far, my guess, wild guess, it's a nothing burger to a degree. The action could potentially be in oil or the metals markets, but again, there we have to wait and see. Sometimes you get initial reactions and it's almost like a Fed announcement, and then you see an immediate push in the opposite direction. We just have to wait and see. And I think tomorrow will be more of a tell, especially if we have volume returning. And also next week, we're going to have our first full week of trading after going through 2 weeks of just partial, very light trading volume. So let's start here with the S&P ETF, the spiders. The red line we're just going to ignore for now. That's the 20-day EMA. The orange is the big one. That is a 50-day simple moving average. That is a big institutional moving average. Then we have the white, which is the 100-day simple moving average, institutional moving average. And then we have the really, really big one, the 200-day simple moving average in yellow. Ideally, we want to see if it's a stock or an ETF, whatever it might be, we want to see it above all of them. The two most important are going to be the 50 in orange and the 200 in yellow. It'll always be that case. What we are, though, seeing at times right now is all of a sudden the 100 days getting some play. So they're allowing stocks, in this case the broad index, the S&P, to penetrate the orange. Then they rescue it at the next institutional moving average, interestingly, the 100. So that's what we're going to keep an eye on. Right now on a daily chart, if I were to zoom in here, where do we sit? Remember, we're going to ignore the red right now. We're above the orange, above the white, above the yellow. 50, 100, 200. All simple moving averages, all institutionally based. We're above them all. So the outlook for this week is bullish. It's that cut and dry, and it makes life really, really simple. Now, if I transition this from a daily chart and we go to a weekly chart, now each candle represents 1 week in the market. What do you see? Well, we're above the three majors, the orange, the white, the yellow. We're sitting all the way up here. We are 1 week removed from all-time highs on a weekly basis. We are bullish here to start the year as well. Now, if I pop back out, go back to a daily, and then we go look at the Qs. Qs saw some selling action on Friday. Now, it was primarily tied to Salesforce, CRM, Microsoft, and Amazon. Now, the Qs were down just 0.1%, well, 0.2%, but they actually opened a little higher and they gave it all back. So if I zoom in here, they are now below the orange. They did it over here, and they did it over here, and now they're doing it again here. Previously, what stopped that decline? It wasn't perfect. This was NVIDIA Day, remember, back in November. But the very next day, High Wave Doji, we held, and that shot us back up. Then we had the December 17th, it seems like eons ago with the holidays. Very next day, gapped right back up, put us right back up. But what's happening is each subsequent rally now is getting less high, so we have lower highs. But each attempt at a sell-off is producing higher lows. And that brings in this pennant idea where we take a trend line, draw it down here. And if you want me to, I can come in here and just draw it for you, just visually so you can see it. It's something like this. And then you can go, oops, try that again. There you go. And then something like this. And we're sort of finishing out this pennant. A break to the upside is bullish. A break to the downside is considered bearish. Now, it's not like 90% probability or certainty that would happen. But when you look at the charts technically, and you're basically comparing buyers and sellers. The sellers are getting less scared because they're turning it higher. The bulls are getting less confident, they're turning it lower. So, or the flip side is the sellers are coming in quicker, but the buyers are coming in quicker. It's the same thing, same difference, if you will. We want to see a break of this. So the question is, with back-to-back days below the orange line, is that cause for concern? On one individual index, no. If the S&P was showing us a similar situation, I would be more concerned. If the Dow was showing us a similar situation, I would be concerned. We're not. Right now, it's just the Qs. So what I would look for, if I get rid of this pennant, watch this white line. This is a 100-day moving average. That acted as support here. If it acts as support again, it continues with the higher lows. So I want to keep an eye on the Qs this week. And then we'll look at the individual. We could do them now. If you, CRM, you can see they were down 4%. If you look at Microsoft, they were down 2%. And then Amazon was down almost 2%. All these guys put pressure on the Qs. Now, if I go back to the Qs, and this was our daily chart, if I switch us to a weekly, what do we see here? Same thing. We're still putting higher lows in on a weekly basis, just like that daily chart showed. The dailies, the weekly highs are coming down. We're also in a pennant up here. This is actually bullish. It's not bearish. So the question is, well, what does that do to the outlook? Well, I want to look at the other two indexes. Overall, let's go back here to a 1-year daily. We already looked at SPY, looking fine. Qs, not looking so fine, but not terrible. How about the Dow? Let's do the diamonds. Well, if we zoom in here, they were below on the last day of the year, the 20-day EMA just a little bit, and they get right back above everything. So they're above the 50, the 100, the 200. The Dow here looks fine. We also have to be aware that the last 2 weeks of the year have low volume. And it's easier to push price around, run some stops, get the snowball turning into a really big snowball by the end of the day if they want to get things moving. So you don't always pay attention to technical breaks or major turns during the last 2 weeks of the year when you have those holidays. That's why this week is going to be really important. So the Dow looks fine. And then if you quickly go to a 3-year weekly look on the Dow, look, you're way up there. There is nothing wrong with these charts. Now, if we go to MDY, these are considered more risky. So this is S&P 400 mid-cap, 50, 100, 200. We're sitting up here. And then if we go to a weekly chart, we're sitting up there as well, within challenging range of the all-time highs. Overall, guys, when you compare the spiders, Qs, diamonds, and mid-caps, these guys all look fine. The bulls still have the edge walking into the new year. The yellow flag, the caution flag, are over the Qs. Well, if we go back to the Qs and we say, oh, geez, the Qs are starting, if we zoom in here, they're starting to break down a little bit. It doesn't look good. By the way, they're not breaking down. They're just below the 50, but we still have higher lows. We take out this low, and this is going to be really important. If the Qs were to get some selling pressure this week, we took out the low from 1217. That would be also a breach of the 100-day SMA, which is another institutional moving average. That becomes a double sell signal. That would be problematic. That's probably going to put weight on the indexes, you would think. Doesn't have to, but would put weight on all the other indexes. We should probably see maybe a little bit of a pullback into the first week of January. As of now, though, it is fine. But my point is this. If the Qs are doing poorly, they came off their highs for some selling pressure. What did the semis do via SMH? Oh, they finished up 3.6%. They just hit new highs. So when the semis are doing outperformance, the opinion is that is risk on, higher risk is wanted. And remember, the AI trade is part of the semis. So now we can quickly see that the Qs, while they're stumbling a little bit here, pausing, we can say, well, Friday was Salesforce, Microsoft, Amazon. Overall, semis are doing just fine. If the semis were weaker than the Qs and all the other indexes, I would have a little bit more of a cautious approach. We don't. They hit intraday all-time highs. This is bullish, and if you ever want to see it, just go Max Weekly, and you will see all-time highs. Now let's go back to the daily. Okay, so overall, the semis make the others look better in that sense on a technical basis. If we look at the XLF, which are the banking ETF, they held their 20-day. They are above the 50 in orange, 100 white, 200. The banks here look fine. How about IYT, the transports? They were at 1%. These guys look fine. After coming down and kissing the 200-day, the trannies have rallied back up, and now they're just going sideways. This is a bull flag, bullish action. You put it all together. The bulls have the edge this week. The bulls have the edge to start January. And now we just want to see, are the Qs going to do a U-turn here? Are they going to turn? So if we take a look at some of those individual stocks that did hurt the Qs, what was Salesforce doing? It gets above the 200 here, and then Friday, for whatever reason, just gets some selling pressure. It comes right back down. But it's not like it's falling out of bed. It's not like it's all back down in new lows or something. If CRM was breaking down even further, you might say, okay, maybe it's going to hurt the Qs a little more. I think once we get back into a full week of trading here, it just isn't going to matter what Salesforce does. Now, Microsoft is noteworthy because it was down 2%. And how Microsoft goes, sort of the market goes. It used to be, hey, however Apple does, it's how the stock market's going to do. Now it's transitioned away from Apple into AI, and Microsoft is part AI as well. And Microsoft was down hard, but it was a holiday week. You see, you have to take it with a grain of salt. It's like, it closed below its 200-day moving average, which was previous support. That usually is a big problem, but it was a holiday week. If you're trading Microsoft from an educational perspective, you do not like Friday's action. This is bad, but it's a holiday week. And the indexes are holding up just fine. So everything gets muddied. We really need to see how this week goes. If I was looking for a new, let's say, virtual trade on Microsoft, it certainly wouldn't be from the bullish side. I mean, if we take out these lows from 11.25, you basically have like a tweezer bottom in here. That would be problematic for the stock. Microsoft could go down and equities still go higher. I mean, could you imagine a gap fill all the way down here? And all of a sudden this beautiful double top with those bat ears, or whatever you want to call it, owl ears, ends up coming to fruition. So right now it's breaking down. If this, by the way, I'm trying to keep this video short, but there's so much I could say. If this breakdown did not occur during a holiday week, this would be significant for people that are following Microsoft. Friday's move was bad. I mean, it looks like you want to come here, at least to the top of the gap, or you fill the gap. But holiday week, things can get sloshed around. But if I go into this further, the fact that it couldn't really bounce very far off the 200-day in yellow is also a bad sign. I'm just saying this gets an asterisk because it happened during the holiday week, or it's exactly how the master planners wanted it to be. So that's Microsoft. And then Amazon was the other stock that was hurting the Qs. These guys were down 1.87%. The candle looks worse than what it is because it had traded all the way up here. Then it's down here. You're sort of just caught in this trading range. For folks that are following Amazon, where I would be concerned technically would be a close below the 200-day moving average in yellow. Because ever since the tariffs and we got above the 200-day, it's only finished one day by pennies below it. And that was the middle of October. And it quickly got right back up. So a breach of that would be very noteworthy. Therefore, you could set alerts right around 217, so your broker notifies you if that were to happen, and then just see where it closed at the end of the day. How about Apple? Apple, a large back and forth day on Friday. It also could just be rounding out their accounts. Traders just going buying, selling for whatever reason. Apple did close below its 50-day by a little bit. Technically, that's 2 straight days. Technically, that's bearish. But it's a holiday week at year end, so it gets an asterisk. Really want to see how this week begins to trade. How about, what else do we have here? NVIDIA. NVIDIA was up 1%. We zoom in here. It's staying on top of the 50. Someone's coming in and defending the 50-day in orange right now, whoever they are. But then it gets up a little higher and they're selling. So you're starting to get compression in here. NVIDIA is bullish on the daily chart, which also bodes well for the market from a day-to-day basis. Palantir, on the other hand, PLTR, this thing dropped about 5.5% on Friday. Volume, while it was decent, and if you think back to my previous video, I said just beware of light volume moves. Some of these moves like Microsoft or Palantir, they occurred on larger volume. But it was a holiday week, and you throw that, asterisk in there. The target right now, though, would be the 200-day moving average. If you were following Palantir. Doesn't mean it gets there, but given how we've now closed 2 straight days at the lows below the 50, it looks like it wants to drop down to that 200-day, which would be the next major technical target. How about AMD, Advanced Micro? Up 4%. Volume actually picked up. It's like they were selling Palantir, if you will, theoretically, and going and buying this one, selling Microsoft, and then going and buying this one. If AMD can get back above its orange, notice that's exactly where it tagged it on Friday. If it gets back above there, then you go back up here towards that double top at 267. Now, how about Netflix? Remember, Netflix does not enter its seasonally bullish window for about another 10 days or so as it comes into that next earnings report. Netflix was down almost 3% on Friday. Volume was decent. Is that a bad thing? Well, I guess if you're holding the stock, yes. But if you follow the seasonal track records, we know from previous videos that this thing has a 95% track record at that next earnings report and then into the following 13 weeks. That window's not now. So therefore, I wouldn't want to touch this with a 10-foot pole yet. Consider touching it just because it's in the wrong window. This isn't the window when it usually does the best. So whether it's the merger, whether it's something else, just let it go. Just let it free fall. And then we'll prepare for that earnings report. All right, that takes care of all of those. Oh, before we do the metals, I had a question on trends and moving averages and how these work. I quickly found 2 examples for you to try to keep this video under 20 minutes. Here's Lowe's. And if you remember, back when I did a video at this earnings report in the middle of November, almost a month and a half ago, this is like an island reversal type pattern, a bullish one, a bullish reversal where you have a gap down and then a gap up. You have an inverted hammer down here. This is massively bullish. It comes up and now you're just testing the 50. Ironically, on Friday, you got caught at the 100. But here's the takeaway. If you have stocks that are moving, I would strongly encourage you to consider putting in a 50-day moving average. It's not going to be perfect. It never will. Nothing is. But you'll be very intrigued to find out that these institutional moving averages act as inflection points. They are litmus tests. Who's getting the upper hand in that tug of war? And here with the 50-day, since the last 7 to 10 days, they've been buying it. Whoever they are, we don't know who they are, but someone has. It certainly wasn't me or you as a retail trader, and we're buying thousands of shares. It's way beyond that. Lowe's is trading 1, 2, 3 million shares down here. So if it breaks that orange, then you go to the yellow, it breaks the yellow, then you start targeting down here. So this is a clear line that's being supported, and they buy it and they buy it and they buy it. Now, if you come to something like CAT, look at this thing. Ever since it got above its 50-day in May, post-tariff, this thing has gone bonkers. It got near the 50 in September. It hit it on the 17th of December, stopped cold. It then hit it on the 31st, New Year's Eve. And what happens on Friday? It catapults. So whether you're trading a stock like a Lowe's, a retailer, whether you're trading Hormel Foods, whether you're trading Caterpillar, it almost doesn't really matter. It can be a tech stock. If you have a moving average that whoever they are defending, when you breach that moving average, that is your change of trend. That's, quote, your sign that the appetite for risk in this stock has changed from being long to, now they're selling. So just watch that 50-day on Caterpillar. And I could remain from a bullish technical perspective forever until it gets below the orange and you finally say, people are finally taking something off the table. And by the way, because it's an institutional moving average, is it by accident or are institutions stepping in and they buying those dips? And before you know it, you end up at someone's doing it. It certainly isn't a retail trader. Now, real quick here on gold and silver, we could see potentially moves in oil or these guys. You just have to wait and see. I was going to wait and do this video for you at 8, 9 o'clock p.m. Eastern tonight. But even if I waited another 6 hours to do this for you, who knows what's going to happen by 9:30 in the morning? Whole bunch of stuff changes. And in the metals markets, they love finagling, funny businessing in the middle of night. Remember the previous video I did? I said warning on silver. They're going to raise margins. If I had to guess, they're going to do it in the middle of the night, and it's going to affect the price of silver. And lo and behold, and gold, that's what they did. They nailed it on silver. They did another margin increase. Who knows if they're going to try it again. They are trying to whack it. It's all in the name of risk mitigation, and then you just have to cough and laugh. But please just be aware the same thing applies with metals at these prices. I call them shenanigans, convenient shenanigans during weird hours to catch people off guard. But on gold here, you gap down, you're playing hot potato with the 20-day. As long as gold stays above the 50, the bullish trend on the daily chart remains intact. Just watch that 50. Now, if you do silver, here was the margin. I warned you. It went from here on 12/26, and I told you, literally, they're going to do it on the weekend. And they did it. Some of you guys wrote in thanking me. I appreciate that. It's only because I lived through it before. This is the time they do it. Next day we go up. and then we go right back down. And then they did another margin hike. So by putting margin hikes through, it does force selling if you can't cover the new margin. So the higher silver goes, they might continue to try and break it. But the flip side of this is they've done 2 margin hikes. They haven't broke silver yet. They haven't been able to crush it to the downside. If you go back to 2000, I mean, just watch. We did this before, but if we do max daily, sorry here, and we go back to 2011, this is what caused these sharp drops when silver went from 48 and before you know it, it was in the 30s. This was the margin hikes they do in the middle of the night. They love doing it on weekends. And the same thing's playing out now. The difference is you could say, well, now it's closer to the end game, but this thing has gone up so far, so fast. If silver doesn't start dropping, I wouldn't be surprised if they try another margin hike if that's their plan to try to break these things. What I would do is this. Please be aware that because silver and gold trade around the clock, you're going to see these things constantly gap. It's not like it's a regular stock, if you will, in the stock market. Expect big moves, volatile moves. Expect margin hikes are coming. And you could trail something up like an 8-day EMA. So if I take my mouse and double click that, and I make that an 8, and I click OK, now it'll sort of pair it with the stock. You would have been below it on New Year's Eve, and then you're above it here. You got to do something. So an 8-day already would have stopped you out once. Me, I would do this. You could try a shorter term moving average, but I would just say be prepared for volatility. Expect volatility. By the time it breaks the 20, you'll probably be somewhere down here. They're just going to crush it again. But from a litmus test of which side of the fence you're on, the 20-day in red could be that guide. You're above it, so therefore the chart is still technically bullish. What I'm trying to say here is, whatever stop you try and use, please don't assume it's going to work, theoretically, because when you see a move from 71 to 65, you're going to see 65 to 59. It'll blow through those stops. But at least a moving average gives you a litmus test. Which way is the wind blowing? And it's above the 20, it's bullish. But just heads up, expect more margin hikes if this stuff stays up here, especially if it goes even higher. If we look at the silver miners, SIL, let's go back in here and do a 1-year daily. They were below the 20-day. The metals itself, I think, would be more volatile than the miner. This is a miner ETF. Below the red, I would go cautious and then look for a test of the 50. And then if you do GDXJ, the junior miners, which are traditionally more volatile than GDX, they are right on their 20-day. Their target would be the 50, but look over here, above, below, above, below, above. It was just shaking people out. No moving average will work perfectly, but you need something to say, stand back and wait, or is the trend still strong? Because we're above the red, the 20-day period is still strong, it's still bullish. You're above the 50. From an institutional perspective, you're still bullish. We lose the 20, then you come to the 50. We lose the 50. At that point, unless the investment thesis is long-term, you have to stand aside, because now you could get back into one of these situations where it's just bouncing and chopping you back and forth. All right, I hope you found this helpful. We ended up going over 20 minutes. I do apologize. I do hope it helps in some way. I thank you guys for watching. Have yourself an awesome new year, and I'll see you in the next video. Take good care, guys.